a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about dividend growth ETFs. I have talked about dividend growth ETFs in the past many times, but they have become especially relevant now in the current environment because mega cap tech giants they have driven most of the market's gains over the past few years thanks to the AI boom, and they now occupy an outsized share of most investors' portfolios. So that is why these portfolios they have become heavily dependent on the AI trade, and I don't think that consideration is entirely unreasonable because two-thirds of the S&P 500 earnings growth is being driven by top 10 companies. But this dependence on AI trade that increases portfolio volatility and also the risk of a major drawdown when the AI trade comes under pressure. And that is why we have seen that markets are so volatile and portfolios are also seeing that kind of volatility. And the information technology and communication services sectors together make up almost half of the S&P 500 currently, and these two sectors are dominated by AI related names. Now, I have long recommended that investors hold some dividend growth ETFs in their portfolios. Over the long term, dividends have provided the majority of the market's total return over long periods, and dividend growth ETFs, in particular dividend growth stocks, these ETFs focus on high quality companies with very strong balance sheets and stable cash flows. And those strong balance sheets and stable cash flows enable them to increase their dividends consistently years over years. And also, these ETFs have significant exposure to other sectors because we know that technology companies have historically not been major dividend payers. While some tech giants have started paying dividends in recent years, some others still do not pay one. So today we are looking at three low cost ETFs that have outperformed the S&P 500 index this year, and these focus on dividend growth companies. So the first ETF I'm highlighting is the Schwab US Dividend Equity HD. This holds 100 stocks with 10 consecutive years of dividend payments. And then it also focuses on quality and sustainability of those dividends, charges just 6 basis points, and is ultra popular with 103 billion in assets under management. If you want to learn more about this ETF, go to the quote page on Zacks.com, read our research report and articles, and then you can a nice dividend yield here, 3.15%. You can take this, you can use this link to go to Schwab webpage for this ETF and learn more about the top holdings and sectors. So Abbott Laboratories, Merck, United Health, Amgen, Home Depot, these are the top holdings currently. And in terms of sectors, you will see a lot of exposure to healthcare and consumer staples, and then energy. And these sectors do not get a lot of representation in the S&P 500 index, so you're getting nice diversification benefits here. Now, the second ETF that I'm highlighting is iShares Core Dividend Growth ETF. All these three ETFs that I'm highlighting are from three different providers, and I own SCHD, the first one, and this one DGRO in the ETF investor portfolio that I manage in full disclosure. So this ETF holds companies that have minimum 5 consecutive years of growing their dividends. And it also focuses on the sustainability of those payouts, looks at payout ratio under 75%, and those holdings that are selected, they are then dividend dollar weighted. This is also ultra low cost, 8 basis points, and has 53 billion in assets under management. And again, you can go to the quote page on Saks.com using the link. You can go to iShares webpage for this ETF. So JP Morgan Chase, Johnson and Johnson, Apple also, and then FB, Exxon Mobil. These are the top holdings in this ETF. And again, you get a lot of exposure to financials and healthcare. Information technology is the third largest sector. You saw Apple and Microsoft in the portfolio. The third ETF that I'm highlighting is by State Street. The ticker symbol is SDY. And this goes even further. This looks at companies that have minimum 20 consecutive years of increasing their dividends. And then after selecting those companies, it looks at highest yielding companies and weights them by dividend yield. 35 basis points expense ratio, 22 billion in assets under management. And again, you can go to the quote page on Zacks.com. This is State Street's web page for this ETF. Verizon, Reality Income, Kenview, Kimberly Clark, ADP, FB. These are the top holdings in this ETF. In terms of sector exposure, industrials, consumer staples, and utility, then financials. This of the three, this has minimum exposure to the information technology sector because there are not many tech companies that have increased their dividends for over 20 years. Now, on the next slide, I have the comparative performance versus the S&P 500 index. The Schwab product SCHD is the best performer, 22% return year to date. The other two ETFs by iShares and State Street, they are up about 13% year to date, whereas the S&P 500 index is up about 19%. And you'll also see that these three ETFs are slightly less volatile than the S&P 500 index. Thanks for watching. Make sure to check out Saks.com/promo for an interesting offer. Make sure to subscribe to our YouTube video channel so you do not miss anything. And I'll see you next week.